Hello, welcome back. Today, part 4 of my series on secondaries. And what we're going to focus on today is the attraction of secondaries to investors, in particularly investors or LPs that are new to private capital investing. So my sense is that this will be a really interesting presentation for all the family offices out there, especially those that have only set up in the last 5 to 10 years. So let's jump in. Quick reminder of the JCurve in private capital. What does it mean? That means from year 1 to about year 5, as an LP in a primary private equity fund, you can invest drawdowns. That means capital calls as the GP builds its portfolio. Now, let me basically fly in the 2 bars, the fence posts. Between those 2 blue bars, that's where secondary funds are playing. That's where secondary funds are investing. As you can see, what has been reduced is the so-called blind pool risk. The fact that you're committing to a primary fund with an appropriate mandate, of course, but without exactly knowing what the assets will be in the portfolio. By year 4, 4.5, the portfolio is pretty much 60 to 80% built. So that's where the secondary funds are investing almost until the end of the realization phase. Obviously, what that means is, number 1, secondary funds do not have that dip in the JCurve. They cut off the drawdown cycle and achieve a faster realization of funds. Interesting, pending what your risk appetite and risk capacity is. Secondaries do come with an attractive risk-return profile. And to put this into context, let me share here a graph. Short definition. TVPI, the acronym that most investors are really obsessed with. Total value to paid in capital. That means how much money has the fund returned over its lifetime to its investors in relation to the committed capital from the investors. Obviously, what we are looking for is a TVPI above 1x, right? Because ultimately, you want at a minimum your capital back, which would be 1x, plus some returns. So what the graph here shows is, out of the whole universe of private equity funds, buyout, growth, real estate, venture capital, how many out of those funds are returning less than 1x? Meaning on a fund level, how many of them are loss-making? And those of you who have been with me in the channel for a while, no surprise about venture capital. Venture capital has the highest percentage of funds that are loss-making. Growth equity and real estate are similar. Buyout, the lowest, around 11% of buyout funds will not return the capital invested by their LPs. Private debt, again, lower, with lower risk. And then secondaries. Again, secondaries have clearly the lowest risk for the return. So now obviously we want to know, like, how much do they actually return, right? So here on this chart, you see on the left-hand side, the return median net IRR for secondaries, which is quite respectable. And on the bottom, the standard deviation, the risk of that net IRR. So as you can see, that's what kind of attracts a lot of LPs to secondaries as one part of their private capital portfolio. Again, I will fly this in a little bit bigger for those that wanted to see it. So that's again the percentage of funds with net TVPI less than 1x. That means loss-making funds out there. Now, having heard all that, and I encourage you to listen to the earlier parts of the presentation as well, of the series. My sense is that particularly startup family offices that are still kind of deploying capital and are looking to enter the private market to a larger extent can surely look at secondaries, partly also to diversify their allocation to private capital based on vintage. If only investing with primary funds, diversification across vintages will take a tremendous amount of time. If one wants to diversify today to ensure that risk is reduced, volatility is reduced in private market portfolios, then secondaries is pretty much the best way to go. Thanks very much for listening. Please put your comments below as well. Happy to address questions, and subscribe to my channel. We're surely going to have more on secondaries as the year rolls by.